Good day, students. This is Dr. Mercado. I hope all of you are doing excellent. Welcome back to Accounting 1303, Introduction to Accounting 1. In this lecture, we're going to be going over some content from Chapter 13, which deals with accounting for merchandising inventory. It is very important that before you attempt your assignments, you read the chapter and you go over all of the resources provided so you can be able to obtain a better understanding of the content and you can be able to apply that towards your problems. Okay, I am not going to go over all of the information in the chapter. That is on you, that for you to read. If you have questions or need clarification, please get with me. But it is the student's responsibility to read the chapter. Okay, I'm going to show you the problem that we're going to cover. It is another long problem, so the lecture is going to be a little bit long, but it's a very important problem because it basically compiles all of the different inventory valuation methods in one problem. So I'm going to go over how to calculate inventory, both the cost of goods sold and the ending inventory, using the specific identification, the FIFO, the LIFO, and the weighted average methods. Okay, so it's a cumulative problem. That is why it's long, and you should anticipate seeing something like this on your test. So ring, 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 ring. Make sure you pay extra close attention because you should be seeing something very similar to this on your final exam. Okay, so let's go over some information before we dive into this massive problem. Some information, some background about inventory. Okay, so this lecture does not replace you reading the chapter. I'm just highlighting key points. You still have to go back and read the entire chapter. Okay, but in this chapter, the textbook covers two types of inventory systems: the periodic and the perpetual inventory system. Okay, and it highlights the difference between the two. Okay, so under the periodic inventory system, basically no entries are made to the merchandise inventory or cost of goods sold account during the year. Okay, no entries are done. The balance in the merchandise inventory account is based on a physical count of inventory taken at the end of the last accounting period. Okay, so we basically do inventory once a year. We update our records at that point in time, and that is it. Okay. Under the perpetual inventory system, this is the type of inventory system that the majority of the businesses use. Entries are made to the merchandise inventory and cost of goods sold account as transactions take place during the accounting period. This provides us with a more effective understanding of how much inventory we have sitting in our warehouses. The merchandise inventory account is debited for the cost of all goods purchased, including freight charges, and it's credited for the cost of all goods sold. Also, the account is debited when customers return merchandise, and it is credited when suppliers grant returns, allowances, and discounts. Okay. The balance of the account represents the cost of goods on hand at all times. Okay. The cost of goods sold account is debited when merchandise is sold and credited when customers return merchandise. So, when we use the perpetual inventory system, we have a more accurate record of how much inventory we have as of that point in time. Okay. There is no, a physical inventory is still conducted. Okay. And at that point, if the balances differ, then adjustments need to be made, or it just serves as a point of comparison. Okay, this is what we show per our records, and this is what we actually have. Do the numbers agree, or do we need to make some form of an adjustment? Okay, figure out what happened to the difference. Okay. Even though we keep, under the perpetual inventory system, we keep a continuous record of everything that we buy, sell, returns, all of that good stuff, there can be differences between the actual inventory on the floor and the amount that we have recorded in our books. And some of those main reasons are basically some of the goods can break, can get damaged, they can spoil, or sometimes we have employees that steal some of our goods. Okay, so it is not going to be 100% accurate, but it should be close to what we have in our books. At that point, we conduct a physical inventory and we true up our numbers. Okay, now when we are figuring out the cost of goods sold and the merchandise inventory, which is what we're going to be working on in this problem, we have to figure out, okay, we've got inventory, we have our beginning inventory, we made some additional purchases, that's going to give us our goods available for sale. Okay, so our beginning inventory plus purchases gives us what we have available to sell. The portion that has been sold is reported under cost of goods sold under the income statement. Okay, the portion of goods that have not been sold gets reported under merchandise inventory on the balance sheet as a current asset. Okay, so depending on the classification, if it's sold, it goes to the income statement. If the goods have not been sold, they go to the balance sheet. Okay. Now there's 4 different valuation methods that we can be used or that are covered in this particular textbook. We're going to be using or conducting the inventory valuation using the specific identification method, FIFO, weighted average, and LIFO. Okay, so we're going to be doing in this problem that we're going to be covering next, we're going to be calculating the inventory, both the cost of goods sold and the merchandise inventory, using these 4 methods. Okay, so let's briefly go over each of them. Okay, the first one we have is the specific identification method. Okay, for the specific identification method, this method is used for inventory items that are physically different from each other or that have some sort of a serial number. We need to be able to differentiate each of the items. Okay, some examples include cars, motorcycles, furniture, appliances, or fine jewelry. Okay, so it has to have an identifiable number or be very different from one to the next. Okay. Then we have FIFO, first in, first out. Okay, this is another widely used method of allocating merchandise. Okay, under this costing method, we assume that the first goods purchased were the first goods sold. Therefore, the latest goods purchased remain in the inventory. First one's in, first one's out. We sell our old and we keep our new. Okay. Under the weighted average method, this is another method. Under this method, we basically obtain the costing method is based on the average of the total merchandise that we have. Okay, the costing method is based on the average cost of identical units. Now we have to be dealing with the same unit, and even though the pricing can shift because of course market changes, we have to be talking about, we are selling bicycles, or we're selling hammers. They all have to be the same product. You can't mix one item and another item because they're completely different. When you're doing your weighted average method calculations, we have to be based on the same product. Okay, identical units. Okay, and then we have LIFO, last one in is first one out. In this particular method, we assume that the sales in the period were made from the most recently purchased goods. Therefore, the earliest goods purchased remain in inventory. Last one's in, first one's out. So in this instance, we sell the new and we keep the old. Okay, so if we're selling fruits and vegetables which spoil, would we want to use LIFO? The last ones in are the first ones out. No, we want to sell our old fruits and vegetables because they're going to rot, right? So it depends on what products you're using or what products you're selling. Okay, if it's a product that's not going to spoil, that's not going to become obsolete, that's not technology driven to where, within 2-3 months a new one's going to develop and get released, and then the old ones you're not going to be able to sell them. You want to be able to sell those as they're coming in the door. Okay, if it's something that does not change over time, maybe like screws or like wood or anything of that nature, that this really does not fluctuate as much, then you might consider using another alternative. Okay, so there's just different ways of you accounting for your inventory, for your merchandise. Okay, and there is no right or wrong. As a business, you make an analysis of what you're selling and you make a decision of which method you're going to use. Just note that when you make a decision, that is what you're going to be using going forward. You can't be switching, in July I'm going to do first in, first out. In August I'm going to do weighted average. In December I'm going to do LIFO. No. Once you make a selection of the method that you're going to be using, that is what you're going to continue to use. So it's very important that you make the best decision for your business. You analyze the information and then you decide which of those 4 methods is the best fit for you. Okay? So let's begin because we have quite a bit to do. This is a very, very long problem. Now, this is a long lecture, okay? I'm not expecting you to sit here and listen to me talk for 45 minutes. You can pause it and resume it later, okay? The point is that you listen to it and you have this as a resource for when you're working your problem, you know where am I getting all of these numbers from, okay? Because the videos in Cengage are fairly short and they really don't explain in much detail. So I hope this helps you out here, okay? Okay, so let's get started. So we have suing companies' beginning inventory and purchases during the fiscal year ended were as follows. And then we have a table running from October through September. Okay, we've got our beginning inventory and then our purchases, and then this is the total. We purchased, or we had in hand 4,000 units and we spent $95,600. Okay, we have to use the following information for the specific identification method. So when we're calculating using the specific identification method, we're going to use this data. Okay, they're telling us that there are 1,300 units of inventory on hand on September the 30th. Okay, so we have 1,300 units that have not been sold. Okay, so let's look at this information. We had 4,000 units. And the problem is telling us that we have 1,300 units that have not been sold. So that means that 2,700 units have been sold. So we have 2,700 units that have been sold. We have 1,300 units that have not been sold. So now we need to be able to calculate the sold portion and the unsold portion so we can calculate the cost of goods sold and our ending inventory. And why do we want to do that? Remember, when we are preparing our financial statements, the sold portion goes under cost of goods sold under the income statement. The unsold portion goes under merchandise inventory in the balance sheet. So we're preparing these calculations to be able to figure out what number goes on my income statement and what number goes on my balance sheet for the cost of goods sold and the merchandise inventory. Okay, so we've got the information. Now let's look at the requirements. We are required to calculate the total amount to be assigned to the cost of goods sold for the fiscal year ended September 30th and the ending inventory on September 30th under each of the following periodic inventory methods. So we're going to do the same exact calculation, but we are going to do it using the 4 methods so we can compare the difference between the 4. Okay, we're going to calculate under FIFO, LIFO, weighted average, and specific identification. For the weighted average, we have to round our calculations to 2 decimal places. Okay, so I've set up my calculations like this. Okay, that way we can keep track of our cost of goods sold and our cost of ending inventory. Okay, so let's get started. Okay, now there's different ways for you to do this calculations. Okay, what I'm going to do is I'm going to start off by copying the date. Oh shoot. Okay, let me go back. October the 1st, October the 18th, October the 25th, January the 12th, March the 17th, June the 2nd, August the 21st, and September the 27th. Okay, and then we have the transaction. This is my beginning inventory. First purchase, second purchase, third purchase, fourth purchase, fifth purchase, sixth purchase, and seventh purchase. So all I'm doing is copying my information from my table over here with data. Okay, so I've got the dates and the transactions. Okay, now I need to figure out, okay, for each of those items, did I sell those goods or do I still have them? Okay, now the first method we are using is FIFO, first in, first out. Okay. Now, in this method, you sell the old and you keep the new. Okay. That is how I like to look at it. Sell the old and keep the new. So, if I know I'm keeping the new, okay, how many inventory items am I keeping? The problem says that we are keeping 1,300 units of inventory. Okay. So that means that we have 1,300 units that we have not sold. So that is going to be my ending inventory. Now it says that I'm keeping my new. Which ones are my newest units? The ones in the bottom. Okay. So I'm going to go ahead and I'm going to begin with my last purchase, my 7th purchase. Okay. I know I'm going to keep that purchase. Okay. And let me highlight this. That way we can see the two different colors right here. Okay. Okay. So the blues are my cost of goods sold. My orange color here is my cost of ending inventory. So right now what I'm going to calculate is my ending inventory. This is what I did not sell. So according to the problem, I did not sell 1,300 units. So let's look at that 7th purchase. Okay, and that 7th purchase, I had 700 units that I'm going to keep. Okay, so I'm going to keep 700 units, and they cost me $27 a piece. And let me put this in. Okay, and then I'm going to multiply them. Okay, and that's going to give me 18,900. So I've got 700 units, and then from August the 21st, I got 200. So 7 plus 2, that's 900. So I still have more to go. So I'm going to keep those 200 units. Remember, we're keeping the newer ones. The newer ones are at the bottom. So I'm going to keep 200 units at $26. And then that's going to give me 5,200. Okay. Now, my next one is 800. So right now I've got 700 plus 200, I've got 900, and according to the problem, I've got 1,300 left. So that means I need 400 more units from that 5th purchase. Okay, so on that 5th purchase, I purchased 800 units. I only need 400 to come up with my 1,300 units, which is what I have not sold. So I've got 400 units at $25. Okay, that gives me 10,000. Okay. Let me delete. Okay. So I've got let me delete this one. Delete. Okay. So now I know that I have 1,300 units I have not sold. Okay, and those are my newest units. Okay, that's 1,300, and those 1,300 units are valued at 34,100. Okay, so now this is the portion that we did not sell. We did not sell our newest units, which are these 1,300 units right here. So that means that from this point up, everything was sold. So the difficult part here is that 5th purchase. On that 5th purchase, we had 800 units, and we kept 400 that we did not sell. That means that we sold 400. 400 plus 400 will give you your 800. So we ended up selling 400 at $25. And that's going to give me 10,000. Okay. Let me just expand this one. Okay. So from this point up, I have sold everything because I sold my old and I kept my new. So from this point forward, I can go ahead and just copy and paste the information. 924.50, and then we have I've got 900, and then I've got 300 at $23, and then I've got 200 at $21.50. All of this, the blue represents what has been sold. So I'm going to do some quick mathematics here. I'm going to multiply them and then run my formula down. Okay. And then these, I'm just going to make them like that. Okay. So now this, the blue represents the actual amount of goods sold. So I'm going to get my total. So I sold 2,700 units at $61,500. Okay. So my cost of goods sold, what I'm going to report on my income statement is $61,500. What I'm going to report on my balance sheet is $34,100 for my ending inventory. Okay, so these are the numbers that we want. I'm going to highlight them yellow. Okay. So I'm going to report that I have 1,300 units that I have not sold, and that inventory is valued at $34,100. And during the period, I sold 2,700 units at a cost of $61,500. Okay. FIFO, first ones in are the first ones out. I sell the old and I keep the new. So I kept my newest and I sold my oldest. Okay. So it's just a matter of organizing your thoughts in the brain. How do I tackle the problem? Okay, I like to tackle it. Okay, first, what is it that I'm keeping? And then the remaining is what I've sold. Okay, so that is FIFO. The next one we have is LIFO. Last ones in are the first ones out. So here we're going to sell the new inventory and we're going to keep the old inventory, which is the opposite. Okay. So I'm going to go ahead and I'm going to copy basically this information. That way it's easier. I'm using a computer. I'm not going to retype. There we go. All I did is copy and paste down the dates and the transaction. Okay. Now we can begin analyzing. Okay. Now the problem says that we are using LIFO. Last ones in are the first ones out. We sell the new and we keep the old. So if we keep the old, which are my oldest units? I am keeping 1,300 of my oldest units. So my oldest units begin up here with my beginning inventory. So I've got 400 units at $20. I'm keeping those. So I'm going to keep 400 units, okay, at $20. I'm going to multiply them, okay. So I've got 400, and then I'm going to go down to my first purchase, and I have 500 more. I'm going to keep those because those are my second oldest units. Okay. So that's 4 plus 5, that's 900, and we say that we have 1,300 remaining minus 900. So I still need 400 more units. Okay. Let's look at that second purchase. I have 200 units. I'm going to keep those at $21.50. Okay. So now I've got 400 plus 500 plus 200. I've got 1,100. And I'm going to subtract 1,300. I still need 200 more units. So I'm going to be looking at that third purchase. I've got 300 units. And I'm only going to keep 200 to be able to complete my 1,300 total that I need. Okay. And that is for $23. Okay. So, according to my math, let me delete some of these cells. Delete, shift cells up. Okay. So now I'm going to get my total. Okay. I should have 1,300 units because that is what I have in my ending inventory, which is correct. Oh, sorry about that. So, according to the problem, we have 1,300 units that we did not sell. Now, because we are using LIFO, last ones in are the first ones out. That means I'm going to sell my new and I'm going to keep my old. So these are the oldest units that I'm keeping to be able to come up with those 1,300 units that I need as my ending inventory. Okay. So this is what I have not sold. This is what I have available. This is my ending inventory. Now I need to figure out what was sold. Okay. So let's look at that third purchase. Okay. On that third purchase, I had 300 units and I am keeping 200. So that means I must have sold 100 units. Okay. 100 plus 200 will give me the 300 units that I have here. Okay. So now from that point forward, I'm going to sell everything. So I've got the third purchase. On the fourth purchase, I've got 900 units at $24.50. And then I've got 800 units at $25. And then I've got 200 units at $26. All I'm doing is copying the information from down here. And then I've got 700 units at $27. Okay, let's see. And this is what we got. Now I'm going to do a little math. I'm going to add all of my columns. And let's see what we get. So if you see, I still have 2,700 units that I sold. That does not change. And I still have 1,300 units that have not been sold. So the 2,700 is what we've sold. The 1,300 is what we still have not sold. That is our ending inventory. Okay. So these are the amounts that we're going to report for LIFO using the LIFO method for the cost of goods sold. We have 2,700 units that we sold at a cost of $68,450. We have 1,300 units that we have not sold. This is our ending inventory, and our ending inventory is valued at $27,150. Okay, so if you compare, the FIFO method will give you a smaller cost of goods sold and a higher cost of ending inventory. Okay, so these are the two methods. On FIFO, we kept the new and we sold the old. Under LIFO, we kept the old and we sold the new. Okay, let me just highlight here. And then these right here are going to be that other color. Okay, so the numbers need to jive. You always have to have 2,700 remaining in this particular problem, and then 1,300 is which we have not sold. The 2,700 represents the portion that has been sold. The 1,300 represents the portion of our inventory that we still have at hand. Okay. Now we're going to proceed to the weighted average. The weighted average is a calculation, okay? And we're going to be using the data provided. Okay. So, according to the problem, we purchased 4,000 units and it cost us $95,600. Okay. So the first thing that we have to do is we're going to calculate the average cost per unit. Okay. We know that we paid $95,600. And we're going to divide it by the number of units, which we had 4,000 units. And where am I getting these numbers from? From right here, 4,000 and 95,600. Okay, from the table in your book. Okay, and let's see what that gives us. 95,600 divided by 4,000. That's going to give us $23.90 per unit. Once we calculate the average cost per unit, I can calculate my ending inventory. According to the problem, I have 1,300 units remaining that have not been sold. I'm going to multiply that by 23.90. And let's see what we get. 23.90 times 1,300 units. That will give me 31,070. Okay. And then we can calculate our cost of goods sold. Okay. So we have 2,700 units that have been sold. And oh, sorry about that. 2,700 units that have been sold, and we're going to multiply that by my average cost per unit of $23.90. 2,700 times $23.90. That's going to give me 64,530. Okay. So my ending inventory is going to be this number, and my cost of goods sold is going to be those numbers. Okay. So we can compare. You see, for my ending inventory, I still have 1,300 units, just like I did with LIFO and just like I did with FIFO. Okay. But now my number of the ending inventory cost assigned using the weighted average method is going to be 31,070. Okay. So it's in between the two. Okay. For LIFO, it's at 27,150. For FIFO, it's at 34,100. The weighted average gives you a number in between both the LIFO and FIFO. Okay, so that way it's not as extreme. It's kind of like in the middle. Okay. Plus, it's a lot simpler to calculate. You don't have to do all of these tables and the timing. Did I sell? Did I keep? All of that good stuff. This is a good method, to easily calculate your inventory evaluation. Okay, now we're going to proceed with the specific identification method. Okay. So once again, I'm going to copy this information over. That way I don't have to retype it. Okay. Okay. So for the specific identification, they provided us with this information. This is where it gets a little bit more complicated. Okay. So let's begin. Okay. They're telling you that this is how your 1,300 units that you have remaining are made up of. These are the purchases and the quantities. Okay. So now we're going to go one by one, and we're going to figure out from each item, do we have any of those inventory leftovers? Okay. So the first one we start off with is October the 18th. Okay. So that means that from October 1st, we didn't have anything remaining. So we're going to sell all of those 400 units. Okay. So those are going to be getting rid of. Okay, so we don't need them. Okay, so we have 400 units at $20 a piece. That's going to give me 8,000. Okay. Okay. So that is what we have as sold because we didn't have any that we kept. Okay. Next, we go to October the 18th. On October the 18th, we purchased 500 units, and according to the problem, we have 100 remaining from that purchase. Okay, so if we had 500 and we still have 100 in hand, that means we must have sold 400. Okay, so we sold 400 at $20.50. Okay, and we kept 100 at $20.50. So you see how I broke down those 500 units? We had 500 units, and according to the problem, I have from the 500, I have 100 remaining that I did not sell. So if I have 500 and I still have 100 remaining, that means I must have sold 400. So here's the 400 that I sold, and these are the 100 that I still have available. Okay. From the second purchase, I've got November the 25th. I don't have anything here, so that means I must have sold everything. So I sold those 200 at $21.50. Those were sold. Okay. Okay, from my third purchase, that is January the 12th. If we look here, January the 12th, I have 200 remaining from that item. So if you look at January the 12th, we had 300 units, and I still have 200 remaining. Okay, so that means that I must have sold 100. Okay, so that means I sold 100 at $23 and I kept 200 at $23. Okay. So from that third purchase, I've got 300. The problem says that we kept 200. So those 200 are not sold. I put them over here, and the 100 that we sold, we put it on the other side of cost of goods sold. Okay. Now we go to the fourth purchase. For the fourth purchase is March the 17th. I'm sorry, the fourth purchase is March the 17th, and we have 100 units remaining. Okay, 100 units. So for the March 17th, we had 900. From those 900, we have 100 remaining. That means we must have sold 800 units. So we sold 800 and we kept 100. Okay. So on the fourth purchase, I sold 800 and I kept 100. Together, though, they give me my 900 units that I started off with. Okay. So on the fourth purchase, go back. I had 900 units. The problem is telling you that for that transaction right here for March the 17th, I have 100 units remaining. So that's why I broke it down between the 100 remaining under cost of ending inventory and then 800 were sold. For the fifth purchase, I've got June the 2nd. For June the 2nd, I bought 800 units. If we look here, I am keeping 400 of those units. Okay, so if I had 8, I'm keeping 4. That means I must have sold 400 units. Okay, so I've got 400 units at $25. So, and then I am keeping 400 units at $25. And then if you add those 400 plus 400, will give you your 800 units up here. Okay. August the 21st, 6 purchased. August the 21st, I kept 200 units. So on August the 21st, I have 200 units, which I'm keeping all of them. So I didn't sell any of those units from August the 21st. So from August the 21st, let me see over here. I don't fill this in, but I am keeping 200 units at $26. Okay, and then last but not least, we've got that September 27th, 7th purchase. I have 700 units, and according to the problem, 300 were not sold. So if I had 700 units, 300 were not sold, that means 400 were sold. 4 plus 3 gives you 7. Okay? So 400 units were sold at $27. And then that means 300 were not sold. Okay? Because remember, the problem says 300 units were not sold. Okay? So once we're done, we're going to add them up because we need to get the same amount. This is my cost of goods sold. This is my cost of my ending inventory. Okay, so I want to report that I have sold 2,700 units at a cost of $63,200, and I still have 1,300 units remaining on hand, valued at $32,400. Okay. So regardless of the method that we use, we always have 2,700 in this particular problem. For my cost of goods sold, that represents the actual goods that were sold. And then the cost of my ending inventory is what I continue to have on hand. This is the unsold portion. This is what's available to be sold. Okay. So these are the 4 calculations. And as you can see, they yield, let's do a little summary here. That way you can, well, you can see it here. Okay. So for FIFO, well, no, let me put it on the side right here. That way we can easily see the numbers. Okay. So I'm going to have, so we can compare the method. We're going to have FIFO, LIFO, weighted average, and specific identification. So for all of those, we use the same data. Okay, same exact data. The problem asked you, in this particular case, we sold 2,700 units. Inventory, ending inventory is 1,300 units. So this is my cost of goods sold. Okay, so I sold 2,700 units for all 4 scenarios, and my ending inventory for all 4 scenarios is 1,300 units. Okay, and I'm going to have here the numbers that we're going to report on the cost of goods sold. This is reported on the income statement. And then my ending inventory is reported on the balance sheet. Okay, so let's see what we've got when we put them side to side. That way I'm not scrolling. For FIFO, my cost of goods sold was 61,500. And let me put it like this. And my ending inventory was 34,100. Okay. For my LIFO, I had 68,450. And then for my ending inventory, 27,150. Okay. For my weighted average, I had 31,070. Okay, for my cost of goods sold, 64,530. And for my ending inventory, 31,070. And then for my specific identification, I had 63,200. And then I had 32,400. Okay. So if you can see here the summary, same problem, same inventory, same number of units left over at the end, the same number of units sold. Just depending on the method that we choose is what we're going to yield to report on the income statement under cost of goods sold. That's an expense. Okay, so we have FIFO at 61.5. LIFO gives you the highest. Weighted average is in between. And then we got the specific identification based on the actual units included in the problem. Okay. On the balance sheet, we're going to report our ending inventory. FIFO gives you 34,100. LIFO gives you the lowest at 27,150. Weighted average in the middle of 31,070. And then the specific identification, 32,400. Okay, so just depending the type of product you're selling or what is it that you want to do. Do you want to report high expenses? Do you want to report inventory, which is an asset, a current asset, a high dollar amount under your balance sheet? Okay, whatever the situation is, there is no right or wrong method. As long as you as the business owner makes the best decision, you have to report why you selected that method on your financial statements, as you will be using it every period uniformly. Okay, that way your financial statements, they're comparative. Okay, you're using the same method. Okay, so but as you can see here, we've done the 4 different valuation methods. They all yield different dollar amounts. They're all correct. It's just preference, and then sticking to that preference depending on what is it that you want to report for your business. Okay. Or what kind of calculation. Some businesses don't want to keep track of all of this, and they just go ahead and say, you know what, I'm just going to use the weighted average. It's much simpler. It gets applied uniformly, and it's just easy calculation. Okay, so it's based on the business's preference of what is it that they choose. But as you can see here, they yield different results. Okay. So these are the 4 methods. They can be complicated. You do need to practice. Remember, when you're doing FIFO, you sell the old, you keep the new. For LIFO, you sell the new, okay, and you keep the old, okay. So don't get those. I'm sorry. Don't get them confused. I always like to write down on a piece of paper, what am I keeping, what am I selling? That way I know, okay, I know here for LIFO, I sell the new, so I should be selling all of my newer items. I'm keeping my oldest inventory should be my oldest items that I have, okay? So I hope that you have followed along and you can figure out where I got my information, how the information was transferred from the original problem. It's just a matter of allocating it. Has the goods been sold, or do we still have them available? Okay, and that is what we calculated on each of those. Okay, please make sure that you do read the chapter carefully, as very important information is included. Please try to practice as much as you can. Utilize the 2 attempts provided on your assignments to get the most practice possible. Okay, so that is basically it for this lecture. Until next time, have a wonderful day. Bye-bye.